Today I'll be talking about inflation, the effects on our wallet, how inflation is measured, historical reversals in inflation, the pros and cons that inflation brings, and much more. Welcome to the Invest with Jiří channel. I cover financial topics from getting rid of debt, handling money properly, finding ways to make money, and most of all, I focus on investing. If you are interested in these topics, check out my Patreon in the video description and click subscribe and the bell to be the first to access my latest videos. Let's do this. Inflation is the magic tool of economics, which, as you will see later, uses price increases to weaken purchasing power. We often see information on the TV news about the current inflation rate or inflation over the past year relative to the current inflation rate, and all of this helps us understand how inflation evolves over time. Inflation is stated as a percentage. For example, normal inflation targeted by central banks is between 2 to 3%. In order to be able to measure inflation, a basket is used of selected goods and services over a given time span. The measured values can be tracked by two indices, the CPI or PPI. The CPI, Consumer Price Index, tracks on 94,000 items of goods and services, and the contents of the consumer basket are different for each country. For example, if the price basket increases by 2% over the course of a year, we can say that consumer inflation is 2%. The second way to measure inflation is the PPI, Producer Price Index, which measures producer prices over time. It's an indicator of inflation based on the prices of goods before they are delivered to the consumer. Now let's look at how inflation in the US has evolved over history. Where were its highs and lows? As we can see in the chart, inflation in the US peaked in 1946 at 18.10%, in 1947 at 20.61%, and in 1974 25%. These are the extremes when the purchasing power of the people declined significantly. Purchasing power is an interesting indicator. Using the example of $1, let's see from 1930 how many dollars we would have had to spend to maintain its purchasing power in subsequent years so that we could buy with it what we could buy in 1939. As you can see from the table, the value of dollar was already $2.56 in 1960 and $6.54 in 1980, $15.40 in 2000, and a whopping $26.46 in 2020. Let's summarize. In 1939, we bought a good or service for $1 to be able to indulge in the same service or product 81 years later for $26.46. A difference almost $25. Wow! Dividing that by 81 years, the increase from 1 year to the next average $31.50. There are several types of inflation. And states control it through monetary mechanism by printing money, devaluing the currency, or lending new money as a credit. The mechanism by which inflation is driven can be divided into demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation occurs when the demand for goods and/or services is greater than businesses are able to produce. Simply, when demand is greater than supply, producers are unable to meet the demand, so they raise prices, and this creates inflation. In cost-push inflation, the price increase is due to an increase in prices for producers. If you bake bread and flour is 15% more expensive, you have to increase the final price to pay for the cost of production. In the case of built-in inflation, The increase in inflation is due to upward pressure on workers' wages, because when prices rise overall, people push businesses to raise their wages and as a result maintain their previous standard of living. Inflation is one of the important economic indicators that affects absolutely everyone. We can look at them positively or negatively. It is up to us. On the negative side, we see food becoming more and more expensive in the shops, and what we could buy a few years ago cost twice as much. However, if we have borrowed money for a mortgage, for example, rising inflation is our friend and help us to pay off our future debt more easily. From this point of view, we see inflation positively. Inflation can be defended against in several ways, and these are by investing in assets such as stocks, which are considered the best inflation fighter, or by buying real estate, precious metals, such as gold and, for example, government tips, treasury inflation protected securities, low risk treasury security. The principal amount invested is increased by the percentage of inflation. What were the biggest historical inflationary collapses? Germany experienced, which went into hyperinflation, that is to say, inflation that got completely out of control. Thanks to the reparation that the Germans had to pay back because of the outbreak of First World War, inflation broke loose from its chains. People received the wages twice a day and had to spend them immediately, because in the afternoon they would not be able to buy anything with the money they had earned. Another example was inflation in Peru in 1990 and Zimbabwe in 2007 and 2008. Of course, these are the extremes, and I hope we do not live to see this. But the truth is that if people did not have assets, and that was the majority of people, they lost all their savings in those times and could just use the worthless money to burn on the stove at home. That would be all for inflation today. I look forward to seeing you in the next video. Take care and invest wisely.